Bring that ass back like a boom, 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 boom.
Good morning, everyone. Today is July the 10th, Sunday, week 27, 2022. You're with Boom Traders Weekly Overview. I'm Supernova, and just as usual, let me walk you through the contents of today's session. First thing, we have the session overview, the risk fast model, then the tactical trading environment, current markets, and summary. And within the current markets, we will check on some charts, the indices, some of the underlying indicators that we use to time the market and look for the market's trend. We are also going to take a look at some of the sentiment indicators, and last but not least, the leading groups of stocks. As you already know, if you pick a right stock but the group is wrong, chances are at least 50% of the time this stock will be taken down by the group. So groups are extremely important when you make your stock selection. So first, let's go with the risk vest model. The general signal since the 22nd of November last year is still negative. The general market right now, we see it, it's a bit of neutral. We've had this bear market rally, although you will notice when we look at the charts, we're hitting some pretty important resistance zones on the indices, so we might see some volatility right here. Deep down volume is positive. We've seen a slight change in the posture of the market from these lows, new highs, new lows. Of course, still on the negative side, we still need quite a lot of work for the beating down pretty much NASDAQ tech stocks. And in terms of stock participation, we have it on neutral. For the tactical trading environment, and as it pertains to breakouts, which are the main setups we're trading, we've moved the signal to yellow this week because we've had some pretty good trades, and we see there's some sort of a change. There's quite some stocks that are setting up again this week. If you come to our Discord channel, I'll make sure you see them. I'll list them for our subscribers right there. But there's quite a lot of stocks that are setting up. Of course, it's been pretty much all bios and China. China took some hits. Thursday and Friday was particularly bad for China stocks, but biotechnology and solars also have been strong. And we had quite a few positions in those areas, so we've enjoyed a rather good week. So we've moved the signal to yellow. So that's it for the two sort of market watching summaries that we do here with the risk vest and tactical trading environment. So now let's take a look at the current markets, and this is pretty much the structure that I'll follow. First, we'll take a look at the charts, then a couple of notes in the industry group sentiment, and then we're going to do a summary. So first things first, let's take a look at NASDAQ. This is the QQQ ETF. You can see we've been in a downtrend. You can see this trend line right here. And notice that we've staged sort of a bounce. These lows right here are higher. So we have higher lows compared to the recent lows. And that's a change. You can see it in this entire drop scenario. We never had this situation, so we made a low right here. And let me see if I can just remove the snap is removed. So okay, so we made a low right here, then we made a lower low right here. Even this low is lower than this one. And then we dropped further, we made new lows, we made another new set of lows, and now we're making a higher low. So that's a first, it's a change. Now, I'm not saying this is going to leave the market and we are into the next bull run or something like that, but it's a change, and that's what we are here to do. The other thing that I want you to notice here in terms of the Nasdaq, we've had 5 consecutive days of positive volume. Although volume is not as high as we want to see it, it's not above the average, this orangish line. Volume is a bit lower than we'd like to see it. We've had 5 consecutive days of positive volume, and I think I have to look all the way back here to November quick glance. Yeah, I think it's all the way back here to November of last year when we saw that. Um, so it's a positive change. Higher lows, positive volume 5 days. Now we're hitting the 50. That yellow line is the 50-day moving average. So uh, this is generally some sort of resistance area. We are also hitting the high right here, this prior bar, and this stands at was the highest 296.558, and we have 296.84 for the 50-day moving average. So pretty much we have a zone right here. Now I want you to notice one thing that's very important right here. There's another pattern that is forming up, and it's head and shoulders. So you see this like the left head, the left shoulder. This is the head. This was the right shoulder. So now, usually, what happens with this type of a pattern, and this is the neckline right here, we can expect like 100% move, measured move from the neckline down. So we take this move from the head to the neckline. In this case, this downward resistance support line, and we expanded another 100% down. So this failed. When we basically stopped right here, this failed miserably. We were expected to move lower and then reach 100% extension from this point, from the neckline. This failed miserably right here. And usually what happens, if we now take out the right shoulder, we usually go for the head. So this is a very, very, very important area to watch for this week and see how it acts. Now I said, I need a little bit more volume, but if we shoot through the 50 on volume, most technical analysis will tell you that is a buy signal. So carefully watching the NASDAQ. Now let's take a look at the S&P 500. Pretty much the same. We'll clear those lines, make it a little bit more readable. So S&P 500, pretty much the same structure. However, the 50-day is coming up like 8 points above. So we still have time to get to the 50-day moving average. And as you can see right here, we're going to get some confluence of zones. If we do, let me just put the snapback on, have it right on. So you can see right here that this downward sloping resistance line and this high right here, they're going to pretty much climax right here around 393, 394 zone. So this is what I'm looking for, some sort of resistance right now, if not the 50. And then we do have a very skewed head and shoulders here, so I don't really look at it as head and shoulders. We needed to get a little bit higher here. But from a technical standpoint, you see again the same thing. We have higher lows right here. And one thing that I noticed on Friday, although NASDAQ was pretty strong, look at the S&P 500. We had a negative day in terms of volume. And that's pretty much, it's not an inside bar, but if you just take a look at the body, it's contained within the body of the prior day. So this might be looked at as a continuation pattern, but definitely as far as S&P 500 goes, the market is taking a little bit of a break. IWM, which is small caps, Russell. Well, it does look like NASDAQ, but again, volume is not as positive. And what we've been seeing fairly recently with Russell, it was holding pretty steady for last week. Here's like a range, 1 year and a half. Let me just remove the snap again. So it was like a year and a half in tight range. It broke through the range and now formed the lower range right here, moved into a third lower range. Now it's trying to get back into this range. So if it can stay within this range, basically, we might be looking into some sort of consolidation, moving back up. But we need to stay there and see what happens. One thing that you can definitely spot right here, we do have something like an invert head and shoulders, but again, it's a very skewed pattern, pretty much like the one that we saw on SPY. So we do have a lower right shoulder, which is okay for inverted head and shoulders, but we need more volume right here to come up and reverse this. Again, as with the NASDAQ, it seems like the obvious place of resistance right here, snap back on. The obvious place of resistance right here is going to be the 50. We have this one at 178.15, this high right here. You can see 178.15 is this high, and then we have the 50 at 178.26. So 178.20 or something is going to be our resistance zone for now. If we can break this one, we're probably looking to take out this highs right here. But let's not get ahead of ourselves. Let's look at Dow Jones Industrial. As I said, and you will see it in our charts for the advanced decline lines, the market internals. Dow Jones has been the strongest one, but the volume is subsiding essentially. Look at that, it's like half of the average volume for the Dow Jones Industrial. So it's really going down, although again, technically speaking, it's a positive sign that we have these higher lows right here. So we've pretty much broken the trend of 3-4 lower lows that we've made. Now the question is, can we make a higher high? And again, same thing here as well. Resistance will pretty much come right here at the 50. It's pretty much the same. 318.75, 319.44. So it's pretty much the same thing. Let's look at some of the internals that we use to gauge the market's momentum. First things first, we have the advanced decline line and net new highs, new lows. You can see, as I said, there is some positive change, although starting with the S&P 500, although we did not hit it with huge volume right here on Friday and volume was negative. You can see that more stocks made 52-week highs than they made 52-week lows. You see that little green blip there of hope for the market, and it's a good sign. It's not a huge explosion, it's not a huge bar, but it's still something to be happy with. The other thing that we're noticing, the advanced decline line right here, if you can see right there, nope, no snapping, thank you. If you can see right there, it is in a positive uptrend pretty much with the market, so they coincide. I like to see advanced decline line. So basically this is the ratio between stocks that are progressing upwards and stocks that are progressing or regressing downwards, so to say. I would like to see advanced decline line and the actual price of the index speak the same language. And this shows that what the price is doing is basically correct, and the stocks underneath the price action are confirming that. You can see right here, when we have divergence, we can expect drop. That signals a little bit earlier than the market can drop. So if you can see right here, the market is making higher high, but look at the advanced decline line. It's making a lower low. So if you compare those, look at that. So we have it like that, downward sloping, but the price, the S&P 500 right here on top, is making an upward slope. So there's divergence between advanced decline line and the price of the S&P 500. Now let me take you to NASDAQ, and you will see when we actually issued our sell signal, that was 22nd last year, you can see that actually, and we've been preaching that, the NASDAQ has been on a decline in terms of the advanced decline line through this whole period. So you can see right here, we're going up, the advanced decline line is going down, and that was the 7th of July last year. So actually probably around here, which is the 14th of June of last year, all the way with this high here. I don't think the advanced decline line made a new high actually here. Yep, it didn't actually make a new high. So you can actually talk about the entirety, pretty much that's the 10th of February for 2021. Since then, the advanced decline line in NASDAQ has been showing relative weakness compared to the price. So there's been divergence. Now, we don't trade solely on advanced decline line, but it's important to know that advanced decline line is showing underlying weakness or strength in the market. So if price of the NASDAQ is falling down, but the advanced decline line is shooting up, that means that stocks are stronger than what the market is showing up, and it's only a matter of time until the market actually catches up with the advanced decline line. And this is what happens right here. You can see these massive drops. And this is the first time as well that the same thing was with the S&P 500. This is the first time that the advanced decline line is actually making a higher low. So you can see this is the lowest low. And now right here downwards, we are making a higher low. So positive news, as I said, positive news. Net new highs, new lows, still negative, but there's also looking at the trend. If you're looking at the trend, they're going down. I mean, the red bars are going down. We don't really have a trend on the green bars, but as long as the red bars are going down, that means that net new lows are slowing their pace. IWM, small caps, as I said, volume was not good, but again, we made a higher low on the advanced decline line. However, net new lows have been pretty much steady with some spikes right here. So let's see how this one pans out. And the last one that we have here is the Dow Jones Industrial. I told you, Dow Jones Industrial advanced decline line is making higher lows all the time, and it's been in an uptrend. Now it's forming some sort of a VCP. If you're familiar with Mark Minervini's amazing work on this pattern, it's tightening up here on the right side. So if we're seeing strength in terms of the stocks in Dow Jones, and as I've said a couple of times, the only thing that's probably pushing down this index is the general market and the weight from inflation and higher fuel and energy costs. But overall, the stocks do look healthy. So let me take you through some of the other internals that we use, and then we're going to talk about sentiment and strong groups. Now, first one that I'm looking at is the put-call ratio. Be aware the put-call ratio is dropping significantly, and if we get to 0.75, right now we're running at about 0.82. So if we get to about 0.75, I would say that the sentiment has moved to a bit extreme optimism, and we need to take a little bit of a breather. Now, so far so good. I like that I'm seeing some call action, which also suggests, as I said, that we are getting bullish in terms of sentiment, not so much hedging. So fear is moving away from the markets, which is good for a push through the 50s on volume. I hope so. But beware that 0.70, 0.75 is right around here. So not a lot of room left for this run, at least for now. In terms of market breadth, this is the indicator that I use to basically time some reversals in the general market. We still have some room to go with stocks above their 20-day moving averages at 54% right now. Once we get to the 70, I start to be a bit more conservative trading breakouts, but right now we are okay. Stochastic still in the midsection, so nothing to really worry about. If we get to about 70, 75 here on the stochastics, I would also start to become a little bit more conservative and see how things are shaping up. As I said, fear is escaping the market. You can see VIX, and I'll be aware VIX is fast approaching this lower Bollinger Band right here. And when that happens and the market hits the upper Bollinger Band, we usually get some sort of a reversal. So be a little bit on the lookout for that. So these are the three most important things as well with the advanced decline line that I'm watching. As I said, so far it looks like we are in for some move to the upwards, especially if we're considering the put-call ratio and we're considering market breadth. However, as I said, be careful. VIX is right here at the lower Bollinger Band. S&P 500, no, but NASDAQ is at the 50-day moving average, which is usually resistance. It's a very important zone. A lot of traders are watching that. A lot of stops are placed around it. So that's why it's important, nothing more than that. But you have to be aware of this. And S&P 500, IWM, Dow Jones are close to the 50-day moving averages, so there'll be resistance there as well. Also know that we are expecting another rate hike. I'll put this in my notes in just a little bit, but we are expecting another rate hike, some quantitative tightening. So that might put another stick in our wheels, but we'll see how it shapes up for next market. So that was it for the charts. Let's move on to some of my notes. And then, as I said, we're going to look at industry groups and sentiment and wrap it off. As for my notes, I have a couple of things. Last week we looked at the cycle work for S&P and Nasdaq. I just want to get you a little, refresher. It looks like, if we're talking about cycles in the S&P 500, it looks like we might have bottomed here. Now remember, Ned Davis used the 1-year cycle, the 4-year presidential cycle, 10-year cycle to make a composite for this one. So we just use it as a reference guide. It's not something that you can trade off, but certainly it's a good thing to have something in the back of your head, back of your mind, where you're at in a relation with those cycles. Here's the Nasdaq one suggesting that we might have bottomed here, but there's another one coming in October that basically undercutting the lows. So it's up to see this one. As far as the notes that I wanted to talk about, there are a couple of things that are starting to shape up. And the first thing I want to talk about is the earnings estimates. Now, it's weird that given the situation we are already in, pretty much everybody's expecting the inevitable, which is recession. And I'll show just in a second a chart about that. But the estimates, the earnings estimates for the next 3 quarters, second quarter of this year and then starting the autumn and winter, earnings have not really come down that much. As you can see right here, we have 2.7 and 9.4 estimates for the second quarter, the third quarter, and the fourth quarter. And as you can see, the estimates for the third quarter are actually higher than the ones for the second quarter. So nothing has changed that much in terms of the estimates, which can prove somewhat bad for stocks if the estimates are that high and then we have negative surprises. You know what usually happens. But on the other hand, this is suggesting that a lot of the falling, a lot of the recession and the economic impacts of the recession and interest rate highs, the war, COVID situation worsening again, a lot of this has been already priced in. Now it's interesting to see, but estimates have not come down significantly. So we'll see how it shapes up. And as I mentioned in our Discord, earnings are starting to ramp up slowly this week, but starting next week, the week of 18th of July, we have full one estimates week, a couple of weeks with more than 100 announcements per day. So it's interesting to see how that shapes up. So this is definitely going to move the markets right there and will give us a clear indication of how things are going to be going forward. Now, as far as recession is going, the 10-2 treasury notes inverted again. You can see right here is minus 0.40, so not a huge deal, but most of the financial media is making a huge deal out of it. And there's a guy on Twitter, he's Charlie Bilello, who's posting charts like this. And this is one taken from him. You can see that pretty much every time that the 10-year minus 2-year inverted from 76 to 2022, it inverted before a recession happened. So you have like 6 times it happened, 6 times it was an yes. Now we have a question mark right here. First yield curve inversion, April 06, that's right here. So you can see right here 0.06. And usually the inverted yield curve is a leading indicator for recession, but the times that follow this as a recession begins vary a lot. And you can see this one is in months. The average lead time is 19 months, so a little less than 2 years. Last time it happened, it happened 7 months before a recession, and now it's up to see whether we are going to go into a recession first of all, and then how much time before recession this inverted yield curve will basically give us a heads up. Now, bear in mind, there are other statistics that showing that usually when the S&P 500 estimates are actually down, these are the best times for purchasing stocks, and the largest returns on a yearly basis are formed when earnings are down between 10 and 25%. So mild recession is okay, actually, which is interesting to note. Mild recession is okay, but again, in general, when we're speaking about this whole plethora of macro market events that are happening, we want to focus on the stocks. That's the thing that we trade. At the end of the day, we trade stocks. If there are setups that are setting up in a proper fashion, we take them. Yes, depending on the market conditions, we might alter our exposure or our stop loss. So basically, risking less, being exposed to less risk in the market. But the important part here is to note that we're looking for stocks. I don't really want to pay a lot of attention to those macroeconomic factors. Yes, of course, they're important because they're shaping the markets. But at the end of the day, you're trading stocks. And we're this type of traders that we take specific setups in order to trade. If there are setups, that means that the market is showing you a relative degree of healthiness. So basically, you can trade, and again, as I said, depending on the market conditions, you have to adjust your stop loss or you have to adjust your exposure. But nevertheless, if there are setups, that means that the market is healthy to the degree that you can trade. So on the one side of our heads, we have all this macroeconomic information, but we have to trust the stocks. The stocks are the ones that are gonna, compound your account and your returns, and you're gonna make money off of it. This economic information, yes, it's important, but nevertheless, if you always watch the news or if you always read the economic processes and so forth and so forth, so forth, you might end up never taking a trade, and that's not a good thing. I mean, trade. As you will see at the end of our weekly overview, I basically put try some more. Last week it was a try some, now it's try some more. Basically try to put a little bit more exposure, see how it goes for you. So this is what I have for my notes. I know it's not a lot, but I don't want to bore you with this information and repeating the information from past weeks because it's so relevant. Nothing really has changed, as I've said it multiple times already. I think nothing has changed fundamentally. So now let's take a look at the leading stock groups. All right, so let's take a look at the industry groups that are leading. Just get my pen right here so I can show you guys what we're looking for. Again, MarketSmith growth 250 list right here every week. They issue that, and they have additions and they have deletions. My drawing is just amazing right here. Anyway, so we're not looking really at the tickers. These are the tickers. If you're interested, you can definitely pause this video and see what the new tickers for this week are. But what we are more interested is right here, this category. So industry name. And I'm just looking for names that do pop up right here, several categories that we see coming up. And we've been preaching for, I think, 3 or 4 weeks. I don't know. Medical biotech, medical biotech, medical biotech. Look at this week, they have 6 additions for medical biotech. And from those, these are pretty good names. Pretty much all of them are good names. Also, they have computer software security. Good thing for NASDAQ. Seeing a lot of computer software security coming up. These are 5 names and 6 names for medical biotech. So definitely you can see what are the strong names that are coming up. I don't have any setups on those. But we traded as WIR. We traded this one. I have this one right here, TWNK on watch. Another one is Court. I have Court on watch, XENX, traded that. So it's a really interesting mix of stocks. I'm really interested to see that there's some energy coming up again. You see oil and gas, transportation, Oxy and Dino, 2 very strong names in the oil sector, are trying to set it up something like low cheats. Again, as I said, if you're familiar with Mark Minervini, with Mark Minervini's teachings. So, but definitely the stronger one are medical biotech computer software. As far as deletions go, let's just rank them up again and take out the pen. I need to clear all the drawing. Can I clear all the drawing? Yeah, that's it. There we go. Sorry, I don't usually use this tool, but here with MarketSmith, I think it's really helpful to see what I'm actually looking at. So again, industry name, here sort them out, and you see utility diversified gas dropped huge. I think it was on Thursday, something like 14% or something like that. So this is one issue, one category that is being dropped from MarketSmith. Then what we have right here, I don't think there's aerospace and defense. NOC was setting up from this category. NOC was setting up. I don't know. I didn't have any alerts on it, so probably it's dropping. Seeing that all three other companies from this area are being dropped, but you can see there's almost no computer software. A couple of names being dropped, but generally everything comes from utility gas, utility electric power, utility diversified. So that's good news actually. That takes off some of the pressure from the stock market. If utilities and XLE in general is coming down, that means that the market can take a little bit of a breather. So that is for the groups, as I said in the very beginning. China, Solars, and Biomed is definitely the strongest right now that you can trade. So now let's take a look at the sentiment. This is the American Association of Individual Investors survey, and I usually give you the chart, but I thought that what they have on their website, it's completely free by the way, so if you want to take a look at the website, I'll list it in my notes in the video, but this is what the bullish, neutral, and bearish looks like, and this is our current week. So last week we had 19.4% bullishness, with 52.8% bearishness, still quite bearish. Now if you look at the past week, so we're moving 1 month down the line. Last week, well, the week prior to last week, we had some bullish sentiment coming up, and before that we've been pretty much the same levels as this week. Now also want to notice here on the 27th of April this year, we had the 1 year bearish high of 59.4%. We are still hovering around that percent, so not that higher in terms of sentiment. Fear and greed index by CNN. The previous close that was on Thursday. It was 29. Now we moved to 30. But prior week, I believe we were in the extreme fear at 24. So we moved one step further towards better markets in terms of fear is easing out. And as you can see right here, this is basically the line for the last year or so, the timeline for the fear and greed index. You see we are probing this high right here that we made in May, and of course trying to get back to neutral around the 50. Here's the Bitcoin fear and greed index also popping up. We're still in extreme fear, but this is the last before we move into fear. Last week, just for reference, we were at 14. So overall sentiment is moving in positive direction, and that's also good news. That means that the people we might expect people to start actually putting in some risk, which will drive the markets further up. So let's take a look at the summary and wrap it up. Last week we said try some, and now we've moved that to try some more. Most of the breakouts that we tried are working. Part of course being due to the proper industry groups that we're trading, but most of the setups that we tried are working. And although our risk vest, as I said, still remains on the negative sell signal from last year, you can try to experiment a little bit more, especially with those higher lows that the market has been putting in. Now again, remember, we're close to the resistance lines. 50-day moving averages, the VIX is closer to the lower Bollinger Band. There is also put volume is closing in on that 0.75 zone that we see. Usually the market stops advancing that rapidly and there is some consolidation needed. Overall, it looks like the market is in for some stall unless it can break on high volume through those 50-day moving averages. Then if that'll definitely give us a clearer picture of what we can expect. Again, nothing really fundamentally has changed. The rates are still very much in play. We expect another 75-point hike and then a couple of 50-point hikes till the end of the year. Inflation numbers, we'll see how the numbers come out. War, there have been some talks about trying to find a solution between Russia and Ukraine and Turkey for corn and wheat exports. You know, Ukraine is a huge wheat export. So that will definitely alleviate some of the pressure. But again, it's up to see. We don't know. Again, respect risk. Try more risk, but again, keep it in line with your risk parameters. Don't go full out there and just buy everything. Just remember, we're still in a market that is still going downwards, unless of course proven otherwise. And the Feds are still quantitative tightening and hiking rates, which is never a good thing for the market. So with that being said, I'll let you guys off. Hope you enjoyed what you saw. I hope it was informative and beneficial to your trading. If you like it, please drop a like here, subscribe to our channel, come visit us in Discord, and become part of our trading community. I'm absolutely sure you're not going to regret that. So with that said, I'll see you guys next week and have a wonderful week of trading.